Let's have a great week, everyone. How's everyone doing? Hope you had a great weekend. Silas, you don't get the voice until the webinar starts, which is at the top of the hour for almost 3 years now. Same time, same station, different music every day because we look at various instruments. Welcome to FACE, Silas. Okay, so all last week, Blake, the whole team, Steve, me, we're talking about 1080 being significant, do or die for Euro, held it. Had a decent day Friday on the eclipse. It's a turn. My bias is still to the upside. Interesting confluence with some moving averages here and a trend line. If you just visualize this moving average and the trend line, has a look of a triangle. It depends where you start the base of the formation. It's anywhere from 180 to 200 pips. This formation breakout would measure up towards 1360. We've been talking about 114, or I have. That's where the weekly 200 comes in. Where's this coming in? 1360-ish. Okay. So that's where I think we're going as long as 1080 holds. Everyone with me? Give me a Y if you are. And hooray. Stops finally elected in US dollar yen. So how do we know it's a false breakout? And I'm leaning towards at least one that it may be. For at least a pullback and at least and maybe even more. And sometimes there might be one market that kind of gives you messages on how some of the other correlations may go. And you guys know I was top picking metals last week and worked a few times. One, I was an hour early when we had that Iranian ballistic missile launch. But when you look at gold, and they've been moving contrary to each other, it's actually yen has been correlating pretty tight with gold. So, like everything, I'm not guaranteeing it's going to happen. I just know what I would do if it does. Just like last week when the yen was, I don't know, down here. I said I want to get short at 109. But then when it did this, the night of the retaliatory strike, I said, nah, yeah, I don't fade days like this. It's not only price, it's how it gets to the price. Okay, so here's gold. Okay, for those of you who know me, what might be missing on this? And sometimes this is enough. But you see this and this. Pretty high readings on the divergence, much weaker RSI structure on silver. See, silver never confirmed all the way back from here. So anyway, I think that there is a possibility for a third drive here in gold. 1, 2, 3, and I can't see the US dollar yen moonshotting if that's to happen. So if you want to attempt something like that, you're long on this candle, you're wrong here. You don't want to sit with it. And perhaps we get a new high in gold, one more new high. I don't know what's going to drive it. Maybe this is what's going to drive it. One more wave down in the dollar, up in euro. So we'll see. And I know a lot of people in FX calls going to say, oh, you're going to don't short the dollar. Don't short the dollar. Okay, well, we'll see. So far, I have to respect more than opinions. It's a technical action of euro holding 110.80. Okay, so the S&Ps, the eclipse was good for at least a day trade. You never know if it's going to turn into something major. Most of the readings I had over the weekend still looking for I saw a guy that's looking for 33.30 or something, and I know Blake is waiting for the deal to be signed, especially if we get up to that golden ratio. So that's what's happening. I believe the market that gave us the weakest signal was oil, because look at the oil weekly. That's pretty ugly. So if we get a rally to new highs in the S&Ps, perhaps we get a sympathy rally in oil. I would start probing short 62, 62 and a half if we had it. This is pretty negative in crude oil. Okay. I don't know how you can make anything bullish out of this weekly candle. So compared to gold, even though gold came off quite a bit, look, still closed higher in the week. Silver still closed higher in the week. Oil down sharply on the week. So that's kind of my view of going forward today. I'll tell you what I think your best position trade is going forward? Any guesses? Dollar will kill shorter. I know. Okay. Well, it hasn't yet on the euro. Okay. On the pound maybe, but okay. So I really think that for you, FX Cole, I recommend that you take advantage of this. Good guess. This is your best position trade for the next year. 12 months for the price of 7. And hang out with Blake and, all you guys that want to know what we're doing all the time. In the mastermind group at ForexAnalytix, you'll know. Hey, Blake, are you still short the S&P? Dale, you still short silver? Well, you want to know what we're doing? Pay 8-9 pips a month to find out. That's my market recommendation for everyone before I bring Blake on, who's probably exhausted from coming back from Temecula this weekend. What the heck was that car on that picture that you showed? Looked like a spaceship, Blake.
Lamborghini, Dale.
He's not going to be here?
Probably not, because he
okay.
came back very, very, very late yesterday.
Did you see that spaceship car? Was he driving it?
Lamborghini
Lamborghini Aventador, yeah.
Oh my God. What is it, like $10 million, the car, or what?
No,
around
like you could fly it to Mars.
Around 1.
Yeah. All right, so you're on deck, Steve. What do you think, guys, coming into this week? That little pullback in S&Ps had no follow through, and I'm sure still has some things. I have no idea why cable getting slaughtered and the euro's holding up today.
Well,
Cable getting slaughtered is a little bit of an exaggeration, if you ask me.
Cable?
Yeah.
It's not getting slaughtered, but
pips.
it's going lower. But I mean, the main thing is today we had some numbers, pretty bad numbers. Manufacturing production and industrial production, quite negative, both of them. Although trade balance was much better than expected, then trade balance non-EU, excluding EU, was actually positive. So anyway, the numbers were not good out of the UK, and it's something that is understandable because the uncertainty. I mean, these numbers prove that uncertainty is the worst thing that can happen. I mean, one of the worst things that can happen. And
that's one way of looking at it, Stelion. Yeah. But for example, there is no uncertainty in Germany, and manufacturing also has plummeted strongly. Same thing with the US. Manufacturing is showing a lot of weakness. So I think that
Steve, I'm certainly uncertain almost every day.
So I think that that having to do with manufacturing, it's mostly of a global trend at the moment and a leading indicator.
The UK is unlucky that it has Brexit over the last couple of years and the global downturn.
Indeed.
It's been a double whammy. Yes, you're absolutely right.
Indeed.
But that's the main reason why today it's dropping. Also, we had another MPC member, Bank of England, being quite dovish. Vlieg, whatever his name is, talked about rate cuts. He actually said that if we don't see a pretty immediate improvement in economic data in the UK, he said that rate cuts will be justified. Having said that, he's the most dovish out of the whole MPC, out of all 9 people. So you kind of expect him to say that, but it has been now 2 or 3 members who have been quite dovish in the recent weeks. Remember, we have the Brexit deadline is actually the end of this month, and then we go into a transition period, which could last for years.
For the rest of my lifetime.
For a decent period of time, yeah.
Yeah. So that's the main mover today, actually, Dale. You know, like you said, it's you know, cable is down 100 pips, so or nearly 100 pips.
So on my tombstone, it'll say, Dale wanted to stick around until he saw the aftermath of Brexit, couldn't make it. How about that?
There is even a chance that it will say that on my tombstone, so don't worry about it.
Good one, Steve.
Yeah. Now, regarding S&P and equities in general, nothing happened over the weekend in terms of you know, US, Iran. Iran actually admitted that they mistakenly shot down that Ukrainian aircraft.
I think they had no alternatives, Stelio, because the data were overwhelming. So
yes. But you know, they said that obviously you know, stuff is happening in the background. But what we can see is that there is no escalation at this point. And like we said on Friday, markets are going to like that, and you know, risk assets are going to rally. And even though we're at you know, pretty high valuations, any way you look at it, stocks shouldn't really be here. But what's going to stop them at the moment? I think nothing. And I've said this many times. I think there has to be a trigger for them to have a proper leg downwards, like they did in what was it, a year ago. You know, 20% or 25%. You know, you need a trigger, and in my opinion, it's probably going to be yields again when they start rising. But you know, until that point, what's to stop equities? I mean, I don't know.
It's a good point.
I mean, you can always put short-term trades, like, you know, Steve has caught it quite well a few times, but this is all small dips, you know, and the way the market's been conditioned for years is buy the dip. Any dip you see, just buy it, which is insane, but that's how it's been. And you know, you can't. I am not standing in the way of this juggernaut at the moment.
Yeah, and we have the trade deal to be signed on Wednesday, so you know, we'll see what kind of reaction we get here. And I'm interested. Was there anything still fundamentally that, besides just risk, that finally took the yen to what a lot of people call a breakout over that 109.70 level? You know, what kind of, you know, people are calling it a breakout, but so far, what are we? 10 pips above the highs that it couldn't penetrate for the last
and we still
3
have
months.
And we still have several hours left in the day, and most importantly, you know, will you be buying a breakout from this range when just like 50 pips above where we currently are?
You know what tells me not to, Steve?
We have this.
Oh, you took your charts away. I'm sorry.
Yeah,
put up TLT. That tells me not to go with the yen breakout. Or you could put up bonds.
Here is TLT.
Okay, so if you drew lines off the top and off the bottom, the compression.
I know exactly what you mean. And looking even at the rest of the bonds, you'll see the same type of pattern.
I wouldn't short this.
No, I'm 100% with you.
Yeah, so
I'm 100% with you.
It does. So it kind of tempers my belief that this is a big breakout. Yeah, that this is a big breakout in yen. Or if it's so, it's just another correlation break.
And even if you don't want to, you know, correlate this to treasuries, which of course it makes 100% sense, right?
Yeah.
Just by looking the USD yen in isolation and looking at this long-term descending trend line resistance, I mean, would you be actually buying? Right. I mean, it's currently passing from 110.30. So, you know, would you be buying here? I wouldn't, right?
Yeah. Okay.
So, I mean, we might end up seeing like a big breakout here to the upside, but that hasn't happened yet. So I'm very, very much skeptical as you are for, in my opinion, all the good reasons. So
Okay.
I'm
Oh,
100%
and you
with
know,
you
we
there.
have Peter Bookford to lead off the week in
Oh, we
interviews
have
today.
Peter
That's
So
today.
great. I
yeah,
really
Okay,
like
that's
it.
great,
yeah,
actually.
I
Yeah.
love.
Great.
And so if you want, stick around because he could answer. I said in the tweet I could ask Peter anything, and you know, he can go there. So, all right, guys. So I'm going to let you guys
Yeah.
take over, and I'm not going to tell the rest of the crowd, but here's my password, CKs. All right.
We'll
I'll
see you
see
in
you
a few
guys in a
minutes.
few
Yeah.
minutes. All
Yeah.
right.
Okay.
All
So
right.
actually, one other thing I wanted to add, Steve, about sterling is that the market is now starting to price cuts. Not actually cuts, a cut by September of this year. We're almost pricing a full cut. So just something to be aware of. I always like to see what the market's pricing before I make my my decisions, whether something's right or wrong. But yeah, we're getting to this point where we're pricing cuts, and we know what's going to happen now, right? With Brexit, we're going to get the Brexit officially is going to start on the end of this month. If there is any kind of positive development or any kind of sign that this could actually work and be done within a reasonable amount of time, I tell you what, this cut is going to go away, and I think we're going to be pricing hikes. On the other hand, if it looks like that things are going to be difficult, and if the Europeans remain stubborn as they have done so far, then we could price more cuts. I mean, it's I think we have to wait. It's a pretty big binary event. So
That is very true.
yeah.
That is very true, and it's going to affect the pound a lot more than any expectations for monetary policy at the moment. So
I agree.
It's all about that.
Yeah.
Now, having to do with the pound, I still see the exact same two scenarios tell you here. One of them is that this is some type of a horizontal consolidation, which makes sense. I mean, we had a big move higher from below 120 to above 135 in a very short period of time. Alternative scenario, we're going to see another leg lower. We're going to know that quite soon, actually. I mean, we're currently testing triangle support, in which case, we're going to have like a channel lower. But in any case, I still think that this move is probably going to be an opportunity to buy the cable. Now, is it going to be from here? Is it going to be from 127.50? Not sure yet, because the problem I've talked about it like probably 1,000 times. The problem with corrective moves is that you can't be certain in advance what kind of a corrective move you have in hand. You need to let the price action unfold, and watch alternative formations until you can have increased confidence in what kind of a corrective formation you have in hand. So, I'm more than willing to buy it. But I don't have enough evidence yet to say that I want to do it from here or I want to do it from a little bit lower. But I'm pretty sure that this is not the high that we've seen here in this rebound. So probably this market is going to remain for the time being a market that both buyers and sellers can make money if they have short-term time frames. But I do believe that the next decent move is again to the upside. So
Steve, that's what I love about markets. We have people in the chat room like Amanda and Dominic and other people who have been selling sterling rallies. And obviously they don't make money every trade, but they've been doing very well. And we have other people who have been buying sterling dips. And like you said, if you time it right, if you use your analysis properly, and you obviously with a shorter time frame, you can't just buy and hold or sell and hold.
Yeah, it's okay. It's okay trading either side of the market when the market is not impulsive. Because, for example,
yes,
you remember both of us were very adamant in warning people that cable was not to be shorted for quite some time, right? Because it was the period that it was a one-way train. And as I said a few weeks ago, the easy part of the move is already done. So when the easy part of the move is already done, then it's again a market that can produce profits for people that trade either side. But people should be careful, because I think that this might end up being again for a period of time a one-way street. Following this corrective move whenever it's done. So yeah, for the time being, people can make money on trading both sides of the market, but we know very well from experience and even talking with our friends in Forest Park that there are a lot of traders globally that were blowing up their accounts trying to be short this move from 120 to 135 in the cable. So trading both sides of the market makes sense most of the times, because most of the times markets are not strongly trending, but when markets are strongly trending, you really don't want to be in the wrong side of the market, because it can definitely be fatal to your trading account.
Oh, absolutely. That's why you have to be very diligent with your stops and everything.
Exactly. Exactly.
Yeah, I mean, like on that retaliatory strike, I was an hour early in recommending selling gold, and it rallied another, I don't know, $25. It ended up being right, but the timing was off by $1.
Yeah,
I mean, by an hour.
Yeah.
See what can happen in an hour when you have a blow off move. It's very unforgiving.
Indeed, especially in in assets like gold, silver, oil. I mean,
emotional markets.
Given the right piece of news, these markets can really make a move right within a few hours.
Yeah, it's funny. My stop survived in crude, but not in gold. And crude really, I know, Steve, you were skeptical of it the whole way.
I was very skeptical.
And the weekly candle was kind of like, you're guilty of impersonating a bull market.
The weekly candle and the daily candle that day. I mean, look at this. This is like, I mean, it's one type of a reversal candle that rarely lies. You know what I mean?
Yeah.
This type of a huge.
It's a Trump candle.
Yeah, this type of a key reversal.
Trump, I'm sorry, Trump supporters.
This
I'm
type
not
of
supposed
a key
to talk
this type of a key reversal is like something that you don't find in a daily basis on any market. You know what I mean? It's
look all the way back. You can't find one.
Yeah,
I mean, on the Saudi attack, but even on the Saudi attack, it didn't give it all back the same day. It closed good.
Yeah, I mean, just look at this range. I mean, the highs of that day were above 65.5, and we closed that day actually below 60. I mean,
at a 65.80 stop. It was pure luck.
Yeah,
it was a money stop. Yeah,
it was like a, it was like a huge move. Now, what are the chances that we're currently testing support? What are the chances that we can just move straight forward to new highs from here, ignoring that type of reversal? Nothing is impossible in the markets, but I would have to say from experience that it is a low probability scenario. So in my opinion, any type of a reaction from here, because this is a double confluence, this is if you see, it's like the 200 daily moving average. It's also this ascending channels trend line support. So we might see a reaction from here. We've already seen so far today, we have like an inside day of an inside day. So we've already seen some momentum loss in this move lower.
So maybe a new high in S&Ps and a sympathy failing rally in crude?
Yeah, in my opinion, any rally towards 61 is probably an excellent opportunity to short it.
Thank you, bro.
So yeah, that's what I think about crude. I mean, any move to 61, I think it's a great opportunity from a risk reward perspective to at least look for one more leg lower. Now, it's not unlikely that they're going to diverge, but it is also very likely that gold and silver is going to produce the same type of action. I mean, yeah, theoretically speaking, since both gold and silver tested important supports at 1770 one of them and the other one at this 1550, 1555 area, there is a likelihood that they can continue higher just from here, but they also suffered like some big reversals. So the likelihood that the correction is going to be so short-lived, the chances are not very high. So I would prefer if they also either produced a longer correction in time, so if they kept consolidating like for at least a few more days, or if they suffered a little bit more losses by retracing a bigger percentage of the last move higher. So of course I'm long physical gold and physical silver. I own both of them, but having to do with also trading them, I would be very skeptical in buying them yet. I would love to buy them again if they retraced more of the move, or if they spend more time like shopping around until they end up with some type of a consolidation that keeps tightening and tightening, and then we see a breakout. Speaking of which, this description just reminded me of a pair that actually is worth talking about today, and that is, and probably I should visit it on the 4-hour chart, the Euro Pound. Because I was expecting this move in the Euro Pound to be resolved to the upside for at least one more leg higher. And I think we're already seeing this type of move. So I do think that the Euro Pound is probably a very decent long as we speak from this breakout, before we can consider further weakness. For the time being, I think that, we had one leg higher, clearly a corrective move here, probably one more leg higher at the very least. So even if this is a correction of the, bigger move lower, it should still produce a higher high before we can see more weakness. Levels I would favor are these two horizontal resistance areas at the very least, like 86.80, 87.20. And then we also have a quality target, from the first leg to the second leg higher, which comes at 87.70. So, these are three potential upside targets. So until we get there, probably we might see a period of euro overperformance over the pound. So I think this is one of the trades worth taking a note on. Along with, I was doing some preparation early in the morning. I was also looking at the pound Aussie and the pound Kiwi. So I have to say here, let's go back on the 4-hour chart for those as well, actually. So pound Aussie, there it is. And
Peter,
Kiwi.
I see you. The interview's in about 32 minutes.
If he's here, actually, if I cover everything we need, he can even start earlier. There's no problem with that, Coach.
Well, just let me know.
So, I'm going to move through the questions and, those things that I want to note. And, if I finish earlier, fine. I mean, no need to get him waiting. I'm sure everybody wants to hear what Peter has to say as well.
Yeah, they listen to my dribble all the time.
Mine as well. So,
all right.
So pound Aussie, nice rejection from that horizontal support resistance area, likely to continue lower for one more leg. Pound Kiwi looks even more clean here. Nice move to the downside, quite impulsive in nature. Nice rebound higher, quite corrective in nature. We've also now violated this ascending trend line support in the RSI. So I would also favor one more leg lower for the pound Aussie as well, for the pound Kiwi as well, before we can possibly see another move higher. So I think, those look very decent. That would also, if that point of view is right, having to do with the pound Aussie and the pound Kiwi, would give a little bit of a higher chance in the pound against the US dollar, producing one more leg lower instead of consolidating over time. But, that's not necessarily the case. But, it would favor a little bit more the probability of one more leg lower instead of horizontal consolidation, just putting that out there. We're going to know quite soon, probably within this week, what's the case with those. Good morning, good morning. Dollar will kill shorter. Nah, yeah, speaking of that, we already covered the USD yen. There's nothing else I have to add. And, you know, we go back to the DXY thesis, and the DXY thesis is the following. The DXY can move higher from here. This move lower definitely doesn't look impulsive in nature, but there is no reason to want to be bullish as long as we trade below 97.70, 97.80, because there is nothing that says that we can see more weakness. And being so close to 97.70, 97.80, and seeing that we have actually stalled again here, from a risk reward perspective, being short the dollar here makes more sense than being long the dollar. Now, above 97.80, yeah, dollar can squeeze higher. I'm with you there. But, you know, would I be buying it against resistance? No way. No way. Aussie USD and Aussie CAD. Okay, now let's start with the Aussie CAD and the Kiwi CAD, and then I'm going to go to the Aussie and the Kiwi against the dollar. Okay, so Aussie CAD. Now this has proven to be quite a tough one to trade because it produced this, you know, very nice and symmetrical inverted head and shoulders formation. It then, you know, falsely broke higher from this inverted head and shoulders neckline, you know, stayed there for a couple of days and then plunged through it, you know, suffered like, what was it, like 5 consecutive down days, found support in this horizontal support area, rebounding now, but, you know, this whole price action has made this a much more complicated formation to trade. So I would favor more the downside than anything. I mean, false break higher, you know, not a good sign to begin with. Then, you know, of course we found support here, but, you know, the more we consolidate over time, the higher the likelihood that this whole formation, instead of being an inverted head and shoulders formation, was just, you know, a triangle or a pennant. Deleted the wrong thing. Let's make it again. Something like this.
Hello.
Hey, I'm here.
Okay.
Perhaps we've already broken down from it, right? There's even that chance. So, you know, there's always the chance that this was a bearish consolidation. Let's see, because, you know, if we actually get rejected from here, and especially if we close below this 89-cent area, I think, you know, you should be looking for more weakness. Kiwi CAD, you know, doesn't look all that bearish. Actually, quite the opposite. I mean, we still don't have evidence of what's happening here. It might have been a corrective rebound that's done, but, you know, for the time being, it's holding decently up here. Now, somebody could say that, you know, this is also building on a topping formation and continuing lower. You know, somebody can easily see here that perhaps we have a shoulder head currently working on another shoulder, in which case a break below 86 cents would indicate that, you know, we have a head and shoulders top and perhaps continuing lower from there. So, you know, they might have both topped out, but we need a little bit more evidence to call that. Now, having to do with the Aussie against the dollar and the Kiwi against the dollar, I would refrain from being bearish the Aussie for one and only one reason, because it actually held the retest of this broken descending channel trend line resistance as, you know, acting as support, was also confluencing with the 50 daily moving average and the 50% fib from this move higher. So as long as we stay above 68.50, you know, you can make a decent argument that, you know, it's worth taking a stab being long here against 68.50. So in essence, you're risking, what is it? Like, let's say you're going to risk 60 pips if you want to put your stop loss below there, looking to make let's say 130 just for a retest of this high. So a 2-to-1 risk-reward ratio just to see a retest of that high, and perhaps see a continuation higher. So from a risk-reward perspective, we might as well have already completed a corrective formation from that low, to this high at 70.30. But if you want to have more confidence that that's the case, and then you should be looking for new lows, I would want to see a break below 68.50. Until then, we can still keep grinding higher. I know that this move higher has been nothing close to being impulsive, but that doesn't mean that it can continue for somewhat longer. And at the same time, which adds a little bit more to that scenario, the Kiwi has been pulling back in a very orderly fashion, hasn't even retested yet this broken descending trend line resistance, which might act again as support, as we saw happening with the Aussies channel, right? So, as long as those two are holding above, these trend lines, I mean, it makes sense. If you want to be long, you have a very well-defined risk-reward ratio, and if you really have the guts and those fail, you can even completely reverse your position. I mean, sell your long position and sell against the highs then, and reverse from being long to being short, and looking for more low for new lows. It is a likely scenario, right? So we have some pivot trend lines that will be very important in defining which is the direction of the market, and being close to them gives you the ability to either trade the market right here, right now, or if you're looking for the other direction, be a little bit patient, and if the market indeed breaks in that direction, then you can trade it to the short side. So, it's your choice. I mean, I'm not going to tell you if you want to be long or short the Aussie or the Kiwi. I'm skeptical, as I said, and one of the reasons that I'm skeptical is because the dollar has no trend. I mean, as I've been saying, what we have here in the dollar is a move higher that is definitely not impulsive in nature, and then a move lower that is definitely not impulsive in nature. So, when you have corrective moves in both directions of the market, which is the trend? The answer is there is no trend. So, that makes it, in essence, a binary market. I mean, you can trade it both ways. Just know the levels that are important, pivot levels in essence. And, you can attempt trading them both ways, and you can make money being either long or short. So, that's what I think. Let me see. Hello, I have a little bit different question. What is your opinion for emerging markets, Brazil, India, etc.? Do you think they will outperform S&P, and what will be their performance in case of a recession? Yeah, that's a good question, Dilian. I think more or less we've answered that with Stelios, and we have a common understanding about that. If you've monitored, Gandlach is also of the same opinion, because I'm 100% on that camp. I've been for quite some time.
Peter has too.
Peter
Bookvar. Yeah,
yeah,
I remember.
Another
last year. Yeah.
Another Peter is of the same opinion as well. Peter Schiff. Not by accident. I agree with what Austrian economists say, because I believe in Austrian economics, right? Because it's sound money economics. So
well, move to Vienna.
Yeah. So my opinion is that, first of all, I tweeted something out. I retweeted actually something that Girl posted.
And malinvestment.
No. It's a few days ago. Let me show it to you. This one. Let me bring my tweet deck here momentarily. This one. So this is the line. The blue line is U.S. equities, and the yellow line is U.S. equities. Global equities minus the U.S. Now look at this huge divergence, and as you see, this dates back to the 60s. So even from a mean reversion perspective, do you think that this can keep on for much longer? In my opinion, as we were talking, with Blake and Stelios, etc., this period of overperformance is going to be over, and it's going to be over within this decade, and in my opinion, quite early in this decade. And the reasons are already there. The fundamental reasons are already there. US is probably in the worst fiscal position that any developed nation is at the moment, right? It's actually running a real deficit of around 7, 8, 8.5. Perhaps we're going to reach 9% this year, with the exponential increase in the deficits and the unsustainability of the debt increase, and nobody seems to care about it. So I think that during the next recession, the US dollar is going to take a huge dive lower, and that on its own, US dollar underperformance and continuing the long-term bearish trend is going to help emerging markets immensely, because emerging market economies have a big percentage of their debt denominated in dollars. So in essence, dollar weakening will immediately translate to a huge debt relief for these countries, right? So I do think, Dillian, that during the next business cycle, I think that emerging markets can overperform once again, as we saw a few decades ago happen. That's my thesis, and that's what I believe in.
It's beginning to, isn't it? In the last couple months?
Yeah, but you get a lot of false starts, so
Right.
it's
Okay.
going to be good to have a little bit more of an evidence. There is
Okay.
a weird question: is Greece going to leave the EU? From Steve. Greece is probably the best performing country of the EU during the past 6 months, and I believe that this trend is going to continue. Greece is actually in a fantastic fiscal position. It's running roughly a primary surplus of 3.5% of GDP. So I've said that some time ago. Greece is one of the best positioned countries for the next recession, because while others will have to make big fiscal adjustments, Greece won't have to do that.
They already did it.
Greece already went through a very, very painful,
Forced.
painful period of 10, 12 years, 10, 11 years actually.
Thank Christine Lagarde for that.
This is a big discussion to be had.
Don't do that, Dale. Come on.
Yeah.
Come on.
3 hours later, he's going to be still talking.
Yeah.
Oh, is she on today? Oh, okay. All right. Yeah.
I agree with Steve, by the way. We are well positioned, but we had huge damage done over a decade. So
Yes. So
it's hard to herd a ship that's already sunk to the bottom of the ocean.
Something like that. So trust me.
Okay.
I think that the last country that is going to be of concern in the next recession is going to be Greece in the EU. So I think the chances of the EU leaving, of Greece leaving the EU within, let's say, the next business cycle. So because nobody can predict further away. I mean, it would make no sense. But
how about the EU replaces the euro with the drachma?
If you're asking me what are the chances that Greece is going to leave the EU within this decade that just started, I think as close to zero as it can be. So don't bet on that.
Steve's very bullish, and it's not just his, patriotism and love of country.
Oh,
he's got the numbers.
It's definitely not patriotism, because I'm the first one that was saying until 2-3 years ago that Greece is an unfixable mess. You know what I mean?
See, you were wrong.
No, not exactly, because it was an unfixable mess for quite some time.
Okay.
Not that it's a fixed mess. Let me be very clear, right? It's in better condition than others. Unfortunately, I think that globally the vast majority of economies projecting 50 years forward are unfixable messes. Unfortunately, and sooner or later, and the sooner we face that reality globally, the sooner we can get back into having some, proper economic growth based on facts and not fantasy, and not fake numbers. But, it is what it is, and personally, I can't do something about it, unfortunately. Ziggy. What do I think about the Russell 2000? I think that the Russell 2000 clearly shows that the whole concept that the US is doing great, if only it wasn't for outside forces, is fake. Because the Russell 2000, as you very well know, is consisted of stocks that are not like mostly international. They're like mostly based on the performance of the local economy. So if that's the case, why is it the worst performing of the US stock indices if US economy issues all come from abroad? I mean, if that was the case, then the Russell should be overperforming by a wide margin what the S&P, the Nasdaq, and the Dow Jones are doing. Of course, I'm not saying it's bearish, right? I mean, it's still in a massive uptrend. So I'm not advocating that it's bearish, but it's still underperforming, and that should tell you something. Now, if you want to be short US indices, I would understand why would you would want to choose the Russell, right? Now, if you want to be long, as I said, I mean, it's the only one that hasn't produced a higher high in quite some time, and that says a lot. By the way, speaking of which, and since we didn't mention it, the major stock indices, the S&P and the Nasdaq, for example, are at almost at all-time highs. But keep in mind that both of them are testing like important formations. They're definitely extremely overdone in the short term. So I'm still expecting a corrective move lower to start either from here or, from a little bit higher than from here. Keep in mind that every single indicator is showing extreme greed, extreme complacency. We have, for example, we have extreme DSI readings, we have positioning readings, we have like, I think something like all-time or anyhow multi-year short interest lows for S&P. So, any way you look at it, it's a very dangerous proposition being long up here. So, you want to be bullish those indices, you need to wait for them to produce a decent corrective move lower before you can even, considering looking higher.
Rega
right?
showed a great chart on the greed. He posted it in Skype over the weekend. You got it?
Who did that? Oh, Grega. Yeah, I did see it.
Yeah, show that one.
Let me find it, and I'm going to show it. Yes.
Because it's even more extreme than it was at other.
Oh yeah,
areas.
we have a lot of charts that have really entered, lunacy territory. Okay, found it. Equity put call ratio inverted. Found it. Right here. There you go.
And then the extreme reading. Yeah.
There you go.
Highest on the for years.
Yeah, highest dating a couple of years back, and as you see, every time we've exceeded this this reading, we've had decent corrective moves lower, right? As you see, dating back there, and now we have actually a more extreme reading than what we had in every single occasion that we had these moves, right? You can see it clearly.
Nice chart.
Yeah, indeed. Here it is. So I'll stick to my thesis that I really don't care being short. I'm slightly out of the money because I had taken profits in the money on 1/3 of my position. And I really don't even care about it. I mean, I feel very, very comfortable being short the indices here for at least, if we're talking about S&P points, I would be looking for at least a move towards 3,200. but probably lower than that. But at the very least down to 3,200, at the very least. Now, there is a chance that before we can see that move, we might see another extension higher towards this double confluence of 161.8% extensions at 33.17. But I'm totally fine with that. Totally fine with that. No problem whatsoever. Okay. By the way, coach, 3 drive here, right? Daily RSI.
Yeah. Yeah.
Yeah.
Setting up.
So, yeah. So everything starts smelling like a correction is around the corner. Now, we have a question for USDMXN and USDZAR. I'll gladly have a quick look at them as well. Here is the USDMXN. Now, if you want to be bullish, you can say that, momentum is clearly waning. RSI is clearly diverging. The 61.8% fib from that low, the 2017 low, is holding. And you can, look for a rebound higher, which might be the case. I mean, we might see something like that, right?
Yeah.
But, as a general thesis, we've broken down from a multi-year symmetrical triangle. So as long as we stay below it, I would be very, very careful in trying to be long the USDMXN, right? So, nothing else to add there. Same, more or less same situation, although not a multi-year breakdown as we had in the case of USDMXN, but USDZAR broke down from this triangle and it's currently retesting this horizontal support resistance area and the broken triangles trend line support as resistance. So more or less a moment of truth here, right? What's going to happen from here, get rejected from there, or push higher is going to be an important indicator. So, you like it to the downside, this is a good place to be short. That's what I have to say about it. Quite a pivot here, right? I hear a dragon breathing. Yeah, that's Dale. He's our dragon. Yeah. Let me see. There is your view on Bitcoin. Yeah, thank you for reminding me. And we also have a question. Last week, Blake shorted the market. Is he still short? I have no idea. I honestly have no idea. So you'll have to wait to ask him tomorrow. I think he said Friday that he wasn't, but don't quote me on that because I'm not very sure.
I think he's waiting for the announcement of the trade deal, the signing.
Yeah, something like that. Yeah, but just to be certain, ask him tomorrow. And Blake is always honest. He's going to tell you if he takes a winning trade. He's going to tell you if he takes a losing trade. People that follow him for like 15 years, they can tell you that as a fact. So he's going to tell you whatever it is as it is. Now, having to do with Bitcoin, I have to say that I'm treating this as a breakout here in Bitcoin. We've been stuck here at the 23.6% fib, but I think there is a decent chance that we're going to continue higher, and more or less the same deal here with Ethereum. So I have to say that from a risk-reward perspective, cryptocurrencies look decent for the time being, for more upside. And I think there is only one question that I haven't covered, and then you can, go ahead and start with Peter. I mean, I'm looking forward to hearing what he has to say. It's a question about the Euro Aussie, and here is the Euro Aussie. So the question is, what's happening here with the Euro Aussie? The answer is, it's not an easy answer to give because I was monitoring at this ascending wedge. We broke through the trend line support. It seemed to be like a false break. So now I'm more focusing on this range. I mean, you can see it. We have so many colors here. It's not easy to. Okay, let's use something different. So something like this, right? So, I mean, I would like to see more downside given this price action, but admittedly, I think, in order to have confidence in something like that, just wait for these lows to be taken off. I said last week that, we were close to resistance. So from a risk reward perspective, it made sense being short, and I drew this. So that was a pivot, and it proved to be a pivot. I mean, we got rejected from there, but we're currently back in the middle of this range. So, in the short term, nothing to do here, right? I mean, you want to buy it, you want to sell it. Where's your stop loss? Your risk reward is going to be at best, at the very best case scenario, 1-to-1. So, in my opinion, wait for a break down or a break higher from here before you can make a decision. Okay. Could you analyze the NOK and SEK pairs? Oh yeah, I lost that. Palladium. Oh my God. Okay, sure. Yeah, we have a few minutes theoretically speaking, so let's go fast with them. So Palladium. Palladium. Where are you hiding? There you are. There it is. Palladium, another exponential move to the upside, has already penetrated through this steep ascending channel. I mean, there's nothing to say about Palladium. It's in a parabolic acceleration higher. I mean, if you zoom out, you can see that this move higher is definitely unsustainable in the longer term, right? At some point, I think that Palladium is going to produce a very, very sharp corrective move lower. I mean,
could there be a correlation between Palladium and Apple? Look at Apple. I mean, lay Apple over this Palladium chart.
It is very likely. It is very likely that they're going to look to be very correlated.
Parabolic,
I don't disagree with you, Coach. And
maybe they're putting Palladium in iPhones now. I don't know. Look at
here it is.
Yeah.
As you see, there was
Apple's
a big,
stronger than Palladium. Yeah.
Yeah, but if you focus more on this period, for example, since the end of 2018,
look at that.
The correlation seems to be very tight, right?
And I was joking because they were both parabolic, but anyway.
No, I didn't find it as a joke because, I immediately knew that it was a valid point, actually.
Okay.
That's why I immediately overlaid it. So, yeah, here it is. Speaking of Apple, another instrument that has gone completely parabolic, Apple, Microsoft, all of that have gone completely parabolic. And keep in mind that since a year ago, I was talking about that with Stelios actually over dinner that we had on Saturday. Look at this. Beginning of 2019, with earnings not having changed since then for Apple, more or less unchanged, Apple was trading at 140, and it's currently trading at 310. So there is a very, very easy question to be had here. What was the fair valuation for the same earnings, more or less, 140 or 310? You be the you be my guest.
Probably 230.
I'll tell you something. Can we both agree that 310 is not the fair?
Yeah.
I mean, we can make an argument.
Maybe 140 was undervalued, so maybe halfway back is.
That's what I want to say. You can make an argument that 140 was not fair value, but can you easily make an argument that 310 is the fair value? No. You know what I mean?
It depends if you ask Tim Cook or someone else.
Yeah.
And everyone else thinks it is that I see on CNBC. In fact, I'm going to ask Peter about it. So
probably it's the same type of people that thought at the end of 2007 that everything would be all right because the problem with housing market was very isolated, right? You remember all the pundits saying that there's
but the percentage of Apple now of the S&P, I think, is, I mean, if Apple corrected 10%, the overall market would definitely have some problems because of its market cap now.
You don't have to worry about that because when Apple corrects lower, you can see the chart here. When Microsoft corrects lower, just a few examples.
Yeah.
When Alphabet corrects lower, you can see another chart here that has gone completely parabolic, right?
Yeah.
There's not going to be a 10% correction. I mean, 10% is going to be the first 3 days probably.
Okay.
So, yeah. I mean, yeah, you're going to see something.
You live in interesting times.
We will.
We will.
And it's not going to take more than, a few months to a year. Let's just say that even if they can make it through until the US elections, with this market being more or less, untouched. I would be very, very careful following the US elections, having a thesis that this bull market is going to be resuming, right? So, it is what it is. Anyhow, enough said from my side. I'm really interested to hear what Peter has to say about all that.
Okay, thank you, Steve.
Thank you, Coach.
Peter, I'm going to promote you. I'm not going to do the same joke I always do. What happened? I don't see Peter here now.
Let me see. Yeah, I don't see him either.
Huh. Must have gotten the time wrong because he was here all through the webinar.
Okay, you want to ping him on
Let me see.
Twitter, or whatever. Yes, I can see that for Apple if the monetary policy has changed. Don't dream S&P correction, guys. Trump is supporting this market. If presidents supporting the market was a guarantee that the market would never go down, trust me, every single stock index would be a multi-decade. Oh, there he is.
Hi, Peter.
Can you hear me? Can you see me?
Yes,
I can hear you.
We can hear you. And in order for you to share your screen, I stopped sharing mine. You have to browse over one of the buttons that says share. It's green colored, and then it's going to ask you to pick the screen you want to share.
Wait, I'm sorry, which button?
There is a panel in Zoom that has multiple buttons. One of them says share.
It's a green box, Peter, with an arrow.
Yeah.
Oh, share. Okay, I see that.
Click it.
Click it, and it will give you a new screen to select, what you want to share. Great.
Okay.
Okay,
We
we're looking
can see
at
your
your
desktop.
breakfast. Yeah.
Okay,
Yeah.
great.
So, Peter, Happy New Year to you, buddy.
Yeah, you guys too. Thanks.
You're one of my favorite guests to interview. Are you going to be showing something or?
No, I'm just going to be speaking.
Okay, then let me share
So,
my screen.
Peter, I see you're a fan of Train Simulator.
That's my son.
That's your son. Okay, nice.
He likes to play with my laptop, so that's his.
Okay, no problem. Would be nothing wrong with you doing a little bit of playing on the side. Everybody needs some R&R, right?
Yep.
Okay, Peter. So I'm going to be showing the screen. In fact, I'm going to be showing your website here, the book report.
Okay.
And Happy New Year. I hope this is a great year for you.
Yeah,
I
you
see
as well.
some of the things you're writing about. What are the major themes and narratives that you're drilled down on going into 2020?
Well, I think there are a couple of really big things that need to come to fruition. I would define the 2019 equity rally as a hope rally, a hope that the Fed would be able to engineer a soft landing, a hope that a China trade deal would lead to an inflection higher in economic growth after the softness in trade, manufacturing, and capital spending, and of course, certainly helped out by the expansion in the Fed's balance sheet. So, in terms of catalyst in 2020, well, we're not going to get a phase 2 this year.
Okay.
Highly unlikely.
Why?
So, well,
because phase 1's a major accomplishment going into the election. They don't want to give them any more.
I think that the Chinese have given us all that they are willing to give. And
Okay.
even Trump the other day said that he wouldn't expect a phase 2 until after the election anyway. And I think either way, we're still left with almost all the tariffs that were implemented last year. So here we are with, phase 1, but stuck with all the tariffs. And the tariffs are on goods totaling about $360 billion. So I believe that trade deal catalyst has been exhausted. The Fed is not going to be cutting rates this year, I don't believe. But if they do, it's because growth took a leg downwards, which is not something that people should be rooting for. And I do actually think that rather than continuing to expand their balance sheet through the second quarter of this year, I think there are light bulbs going off in the Fed that what this expansion of the balance sheet has created is another asset bubble and another expansion in valuations that's disconnected from underlying business fundamentals. So Robert Kaplan, the Dallas Fed president, who this year is a voting member, was the first one to echo that last week when he did acknowledge the rise in asset prices that's coinciding with the expansion of the Fed's balance sheet. Now, I know the Fed didn't intend that to happen because they did that to quell the earthquake in the repo market back in September. Right. But things don't happen in a vacuum, and at least there's one Fed member that's acknowledging the connection between the Fed's balance sheet and the value of credit and stock prices.
Okay, so that was an earthquake, and sometimes, Peter, earthquakes are followed by aftershocks, and they're trying to quell the aftershocks. Is there another seismic event that's going to happen in the repo overnight Fed funds market, and is it really the canary in the coal mine for something systemic?
Well, I think the market now, that overnight market, is becoming addicted to what the Fed has done. And the Fed, their answer to every problem is just throw money at it.
Right.
And yes, it's had a temporary quelling effect on that market, but when they start to extract themselves from it, that'll be the real test on whether this market can walk on its own again. Now, there were regulatory constraints that led to that. So I don't know why they felt that just throwing money at the problem would deal with a regulatory issue. So when the Fed tries to walk away, we'll see how that market can handle it. When the Fed stops expanding their balance sheet, we'll see where credit spreads and stock prices go. And the last thing to wrap this up in terms of what I'm looking for is earnings need to accelerate. Earnings growth,
right.
Or there was no earnings growth. Earnings decelerated in 2019 with a modest decline. So you had about a 4 to 5% revenue increase to S&P top line, but that was more than offset by a decline in profit margins. And I think that profit margin story is going to continue in 2020, mostly because of a rise in labor costs. So the math that the street has that earnings are going to go up around 8 to 10% this year, I just don't understand the math, because that assumes that profit margins out of nowhere start to re-accelerate. And I don't see that, because if the economy gets better, wage pressures will continue to grow, and that would offset any revenue increase. And if you are a company and you see profit margins that are getting squeezed, well, you're not just going to sit there. You are either going to slow the pace of hiring, you're going to reduce the hours that your employees are getting or are working, even though they're getting paid on a per hourly basis more. You may slow down capital spending. You may slow down your stock buybacks. So I think that's going to be an important story in 2020, just as it was in 2019. But of course, it was ignored in 2019 because we got multiple expansion instead for the reasons that I stated.
Yep. Yeah, I mean, it was a Fed year when we had the three Fed officials, two former, singing Kumbaya in January. So I have to ask you, with everything you've mentioned, how do yields come into play with what's going on here? We're kind of trapped in a range in the 10-year between, I would say, about 175 and 2. Which way do you see them coming out? Do you see them coming out one more decline in yields in the 10-year, or have yields already bottomed in your view?
Well, it gets me to one thing that we've spoken about in the past, and what I think is potentially another big story of 2020 is, where do European bond yields go? Because where European bond yields go, I think that's where U.S. yields will go. And even today, the German 10-year Bund yield quietly is at the highest level, or the least negative, since May, at minus 18 basis points. Last August, that yield was minus 70 basis points. So if you see a continued rise in European bond yields, you will see, I believe, a continued rise in U.S. interest rates. I think there's a lot of pressure on the European Central Bank to begin the process of getting out of this negative interest rate regime. We saw it in Sweden at the end of last year, the Riksbank finally deciding that negative interest rates was just a bad policy. And if you do see that in Europe, I think that is the potential tinder for, speaking of earthquakes, an earthquake in the global bond market. because when you take a step back, it's where the bond yields and bond prices are where the major excesses are in this cycle. And with obviously negative interest rates being the epitome of a bubble. So if you start to see them and even the Bank of Japan starting to walk that back, I think that can have major implications for US rates. And speaking of Japan, they may not necessarily walk away from negative rates on the short end, but Kuroda has told us that he wants higher interest rates on the long end. So just imagine 25 plus years of yield suppression in Japan, and now all of a sudden they say they want higher long-term interest rates. I think that's a really big deal.
Okay, so with the scenario you've just painted, it sounds like one of the pillars for euro weakness, dollar strength has been eliminated. Mark Chandler talked about this, and I know you were not a dollar fan for quite some time, and all we've done is move sideways. Could we finally be embarking on a dollar top and a weaker dollar regime? And isn't that the easiest thing to be sacrificed at this point in the economic cycle, that a lot of people won't notice a weaker dollar, but it could help at least in nominal terms, asset prices?
Well, I think it's a mixed bag. Who's been the major buyer? Who's been one of the major buyers of U.S. corporate credit over the past couple of years? It's been foreign buyers. It's been the Europeans. It's been the Japanese, all desperate for yield.
Okay.
So all of a sudden, the euro starts to strengthen. If the yen starts to strengthen, if the British pound starts to strengthen, well, what does that mean to these fund flows into corporate credit? You take even the Japanese specifically. There's a sovereign wealth fund there, essentially, or a big pension fund that's been a massive buyer of U.S. CLOs. Well, all you need is a modest rise in the yen, and all of a sudden you've wiped out a year of coupons. So I would not be rooting for a weaker dollar, thinking that that's going to be the be-all, end-all. Also, that could lead to higher inflation. That can lead to higher U.S. interest rates. So any specious benefit it does give to U.S. multinationals in terms of earnings, I think could be offset by those factors that I stated. So I'm not a believer that that's necessarily going to be good for us, especially when you have corporate credit spreads as tight as they are. And all you need is a reason for those strong flows, to slow down.
Okay, so yeah, a weaker dollar would actually create some risk off, in other words. Is that what you're saying?
Potentially. Now, I think it would be good for emerging markets. It would be good for those foreign companies and countries that have dollar-denominated debt and paying it back.
Right.
I'm more of a fan of a stable dollar, not a strong one, not a weaker one. But I think there's this belief that, okay, weaker dollar is just good for everybody. And I'll argue maybe it's good for some, but it's not necessarily good for others. I mean, we have U.S. interest rates that we need to keep low in order to keep this whole thing going, essentially. And the worst thing that can happen is higher inflation, which ties the hands of the Fed and would lead to higher interest rates. And if you got a weaker dollar of substance, that could lead to higher U.S. inflation. We have services inflation that's already sticky, running at around 3%. So if all of a sudden you tie that with goods inflation that rose because of a weaker dollar, then you may have a more of a difficult situation in terms of interest rates. Okay,
and the yield steepening that's occurred over the last couple months, just a correction of the rubber band snapping back a little bit, or could this be an ongoing or beginning of a secular trend because we inverted and now we're beginning to steepen?
Well, obviously the Fed cutting 3 times certainly helped that yield curve steepening.
That was their goal.
Right, and then you combine that with the rise in European and Japanese bond yields helping to lift U.S. yields, and then you also have this hope for reacceleration of growth, and then you have this. But the last couple of times we had the yield curve inversion that then went to a steepening. Well, that was just on the cusp of a recession because we were steepening more so because the Fed was cutting interest rates rather than steepening because U.S. growth would be accelerated.
Okay, and I want to acknowledge that, we've been talking for a few years now, Peter, and you're definitely a proponent and bullish precious metals as one of the better places to be. We've had a tremendous run, all in gear or could this be also close to running its course, or are we just in the beginning innings?
I think we're just in the beginning. I mean, even at 1550 in gold, you're still about 30% below, actually about 20% below where you were in September 2011. Silver,
Right.
call it around 17, 18. It was
Yeah.
near $50 in 2011. So I think this is just getting going. And I
Okay.
think that the correlation has been pretty tight between real yields, particularly the real 5-year yield, and the price of gold. And if you do, as I said, get a bump up in inflation, well, you know the Fed is not going to be raising interest rates anytime soon. So I expect real yields to get even deeper negative, which would be a big help to gold and silver. And then if we do get that dollar weakness from here, that certainly would be a big lift. I would caution people, though, geopolitics has a tendency to lift gold temporarily, but I would do not use geopolitics as a reason to buy gold and silver. Focus it more on where the dollar goes and where real rates go.
Okay. Do you want to talk a little bit about the commercial and industrial loans? I'm showing your website that they're still going the wrong way, and this is kind of flies in the face of people who think that we're, starting to bottom out with PMI numbers and we're going to turn. What's your point? The chart is obvious. You're looking for continued weakness here?
Well, it's a good statistic because it's a high frequency one. It comes out every week at the end of the week.
Okay.
And this is for the weekend of January 1st. And really just measuring the quantity of loans outstanding. This in this particular case, commercial industrial loans outstanding.
Yeah.
The charts for commercial real estate loans outstanding or credit card loans outstanding. So here we had the Fed, which cut interest rates 3 times last year on the hopes that corporations would borrow up even more. But corporations have been borrowing up on it in a binge for many years now in this expansion. So just because they cut interest rates doesn't really matter when interest rates are low anyway. So I think this shows this pushing on a string type response to the Fed cutting interest rates. Then, of course, you had the fourth quarter so-called trade deal, where the hope was, well, that would kickstart executive confidence on the CEO and CFO level to start expanding again. Well, looking at this chart, that doesn't seem to have been the case. So luckily, we do have earnings from a bunch of banks this week, certainly the large money centers and some of the big regionals. So hopefully they can give some color on why we've seen this sharp drop-off in C&I loans outstanding, which is at the lowest level since March, and it's not something you'd think we'd see based again on the heels of those rate cuts and on the heels of a trade deal.
Okay, and as well, going all the way back to President Trump's tax cut and easy Fed policy, it seems to me, tell me if I'm wrong here, Peter, that any of the gains of liquidity that corporations got from either the tax cut or easier money has really been gone, seems to me to have gone into financial engineering. Is that the way your work points to, that a lot of it has been for buybacks and dividends and really not a lot of hiring, no new plants and equipment, that really all of this money has just gone in to fuel the euphoric market that we have?
Well, that's certainly been, particularly with the repatriation. Now, I think it was very important to cut the corporate income tax rate in order to make U.S. companies more competitive with those overseas. But that's a long-term competitive situation that plays out over time. It really is intended to affect the location decision of a company when they're looking to expand a facility or a plant or build something from scratch. So I don't look at that necessarily as stimulative, but in terms of the immediate cash benefit, the immediate repatriation benefit in lowering that rate, yeah, that mostly went into the things that you mentioned and less so capital spending. But I'm hoping over time that cut would help the competitive positioning of multinationals in the U.S.
Okay, so I normally don't ask you about it, but you're writing about it. So technically, one of the worst givebacks in the market last week, even though indexes came off a little bit and gold and silver came way off their early week highs on the retaliatory strike, but they still closed higher on the week, whereas WTI put in one of the most negative candles I've seen in a while. Is there something else going on in oil that may not be as sensitive to, say, for example, what's happening in gold and other inflation hedges?
Well, I think it's a couple of things. I think people realize that the Middle East and OPEC is just not as relevant as it used to be. That the U.S. pumping 12 million-ish barrels per day is a new paradigm, and therefore mutes Middle East type disruptions. And even with the spat with Iran, it did nothing to impact the flow of oil. So I think that's a reason. Then, of course, you throw in concerns about the demand side because of slowing U.S. growth. I mean, the World Bank last week put out their 2020 global GDP estimate, and it's only 2.5%. Well, that's a pretty punk rate of growth, which means that the demand for oil will likely be somewhat muted. And the supply side, I think, is also somewhat muted, particularly in the U.S. with this falling rig count. But I think what we've seen with not just what happened with Iran, but prior to that, the bombing of the Saudi Arabian installation that had a 1 or 2 day effect, and that was it. So I think oil, or the price of it and its sensitivity to the Middle East, is certainly not what it used to be, and will never be what it used to be.
Well, the oil shares are cheap. They finally started to participate a little bit. Is that still a sector to avoid?
I mean, it is cheap, so I'm usually attracted to cheap things.
Yeah, that's why I asked.
Yeah, so it's. I think if you're looking for some dividend payers, certainly this area is one of those, whether it's Royal Dutch or Slav or whatever. But in terms of getting a sustainable move, I mean, I think you need oil above $75 on a sustainable basis in order to get a real move in energy stocks. Interestingly enough, though, in 2019, the stocks were so bad, but oil still rose about 30%.
Right.
You have the stock market that was up about 30%, where earnings actually declined. So somewhat of a paradox. But yeah, I think oil is a bombed out group. So it's probably a place to be. I'm just not sure what kind of bounce we'll get or when it will occur.
So, Peter, are you on the same page as a lot of guys that are talking about that the next big bubble is in the corporate bond market rather than in sovereigns and other debt instruments? And if so, I've been trying to do a little research. Is there any way or any instrument that you can look at and consider to take advantage of a problem in the corporate bond market?
Well, it's corporate and it's certainly sovereign. I mean, a negative yielding sovereign bond overseas, is a poster boy for expensive and floppy. And certainly the corporate credit names are certainly an outgrowth of that. I think on the sovereign side, I think an easy short is the Vanguard International Bond ETF, BNDX, Boy Nancy David X-ray, as it includes a lot of negative yielding bonds. So here you have this U.S. U.S. mutual fund that is one of the buyers of this negative yielding paper, which is interesting that you probably have a lot of 401ks in the U.S. buying bonds that will cost you money. And then, of course, you have the high yield and the investment grade indices that are very expensive, particularly investment grade, where its spread to treasuries is extraordinarily tight, and a high yield bond is only yielding you 5%. So certainly there's a lot of froth there. And I think if you get another year of declining earnings, which then crimps cash flows, I think there'll be a more discriminating eye on corporate credit, especially since the Fed is not going to be your friend in 2020 like it was in 2019.
Okay, and that's a very important theme. I can't let you go without asking you if you think that domestic politics with an upcoming election are going to play a big role this year. A lot of fear about someone like a Warren or a Bernie Sanders winning over Donald Trump in November. Your take on what's happening politically and any impact it could have for financial markets?
Well, I think everyone knows the obvious what happens if Bernie or Elizabeth Warren win. I think there's zero chance that Bernie wins and only a slight chance that Warren would win. I don't think that either will get the nomination, though remains to be seen. So if it is a Biden or somebody more center, then that will be more of a horse race against Trump. I think a big question, though, is when you look past the presidential election, is what happens with the Senate, because even if a Democrat wins and the Republicans keep the Senate, and it's more of a split Congress, that would mitigate some of the effect of a change at the top. I think the markets won't necessarily start to respond until we get well into the primaries, and there is some sense of who's going to make it on the Democratic side.
Okay.
But as long as I think the economy, if it holds up this year, if the markets hold up, then Trump will be tough to beat. But if, on the other hand, they lose control of the markets and the economy takes a leg lower because we're stuck with the tariffs or earnings decline or whatever, then it's going to be more of a coin toss come November. Again, assuming that Warren and Sanders don't become the nominee, because I think either have no chance to win.
Well, you know, I'm a very emotional person, Peter. And if I was Jay Paul, after the way I've been treated by this administration, I would hike rates a couple times before the election.
Well, I think...
Just because, you know, he hurt my feelings.
Yeah, well, you can imagine the tweet storm if that were to occur.
Yes, I can, yeah.
I think he'd feel like he needs good reason.
Yeah,
and I don't think he'll get that good reason, because I don't see growth reaccelerating here. I mean, I think at best we're going to be stuck in this 2% range, and the Fed thinks that a 1.5 to 1 3/4 Fed funds rate should be correlated to, or it should be the right policy for a 2% type growth rate. I disagree. I think rates are too low, but I think that
maybe just staying on hold would be enough for him. Let me ask you this, and I've had this question before, talked to other people about the fact that interest rates, the way they're moving, is it possible that there's going to be one more advance in the bond market? If you look at the chart, where you could have one more run to the upside in the bond market, and is that really your preferred short over the stock market in 2020?
That's a good question. I really think that the August rally last year in bonds and declining yields, that was right after Trump tweeted about the tariffs on all the remaining Chinese imports. I think that was the last blow off in bond yields. I'm sorry, in bond prices and decline in bond yields, because that was sort of the retest of the summer of 2016 when yields plummeted upon the Brexit vote. So while bond yields may have their declines and rally in bond prices if growth continues to weaken in 2020, but I really think that we're going to get a continued rise in European bond yields, which could be the drag higher in U.S. rates, even if U.S. growth remains punk in 2020. Then also you have all this Treasury supply, which has already impacted the short end of the market and really triggered this repo implosion. It was the first time everyone's been debating for 30 years, when is all this Treasury supply going to mean an upward pressure on U.S. interest rates? And of course, for 30 years, it never mattered. But now all of a sudden, at least on the short end, all this Treasury supply began to matter. And I actually think that it's going to begin to matter on the long end as well.
Peter, thanks a lot for coming in here and sharing your views looking ahead, and thanks for getting a microphone.
Yes.
And I hope this is a great year, people, if you're interested. And I really think that it's an important part of intelligence gathering to get Peter's views. He has a lot of free content. You could go to www.bookreport.com, spelled BOOCK report.com, and also follow Peter on Twitter at pbookvar. So great hunting to you this year, Peter, and maybe we could get back together in the spring, see what's manifesting, buddy.
Thanks so much.
All right, you're welcome. Everyone, that's Peter Bookvar. That's a wrap. See everyone for Turnaround Tuesday tomorrow. And don't forget also our promo. And I'll see everyone tomorrow Don't just count your pips, count your blessings. Adios. Thank you, Peter.
Thank you.